Hello and welcome back to the Financial Freedom Show. In today's episode, we're going to be talking about JEPI, or the JP Morgan Equity Premium ETF. If you enjoyed today's video, please be sure to hit the like button and subscribe in order to stay up to date with my portfolio's changes, as well as new funds that I'm considering. Without further ado, let's get into today's video. So what is JEPI? JEPI stands for the JP Morgan Equity Premium Income ETF. It's an exchange-traded ETF that's managed by JP Morgan. It's designed to generate income while providing exposure to the stock market. It does this by investing in a diversified portfolio of stocks using a strategy called the covered call strategy to enhance income. So the key features of JEPI are that it has income generation. JEPI provides a regular income to investors. It does this through dividends from the stocks it holds, as well as the income that is additionally generated from its covered call strategy. It gives equity exposure, so JEPI invests in a broad range of U.S. stocks, which gives investors exposure to the stock market. This means that you benefit from the potential growth of these companies on the upside. And the last thing is risk management. The covered call strategy used by JEPI helps to reduce risk by generating extra income, which can offset the potential losses from the stocks that it holds. So how does JEPI work? To understand JEPI, we'll have to look at two main components of its strategy. Number one is JEPI invests in a diversified portfolio of U.S. stocks, focusing on companies that pay dividends. Dividends are regular payments made by companies to their shareholders, typically derived from the company's profits. These dividends provide a steady stream of income to JEPI investors. And the second thing is covered call writing. JEPI enhances its income through a strategy called covered call writing. For a covered call, JEPI sells call options on the stocks that it owns. A call option gives the buyer the right to purchase the stock at a specific price within a certain period. Premium income. By selling these call options, JEPI receives a premium payment from the option buyers. This premium provides additional income. And risk reduction. The income from selling call options helps offset any potential declines in stock prices, reducing overall risk. Why would you want to invest in JEPI? There are several reasons why JEPI might be an attractive option for investors. The first is regular income. JEPI is designed to generate regular income through dividends and premiums from covered calls. This can be extremely appealing if you're close to retirement and you're looking for a steady cash flow from your investment. Diversification. By investing in a wide range of stocks, JEPI provides diversification. This diversification reduces risks by spreading your investment across different sectors and companies. If one stock underperforms, it doesn't significantly impact your overall investment. Lower volatility. The covered call strategy helps reduce volatility or price fluctuations in the ETF. This can make JEPI a more stable investment compared to other stock-focused funds. Professional management. JEPI is managed by JP Morgan, which is a reputable financial institution. This means that experienced professionals are making investment decisions on your behalf, which can be reassuring if you're new to investing. Ease of use. Like other ETFs, JEPI is traded on the stock exchange, making it easy to buy and sell. You can purchase shares through any brokerage account without needing a large amount of money to get started. So for the expense ratio of JEPI, the expense ratio is 0.35. This means for every $1,000 that you invest, $3.50 annually is invested in fees. This is actually a relatively large expense ratio compared to other index funds, so it's kind of expensive, but you're getting active management as opposed to passive management, so that's why it's a lot higher. The expense ratio is a critical factor to consider when evaluating any investment fund. It represents the annual fee that the fund charges to its investors to cover management and administrative costs. The expense ratio is expressed as a percentage of the fund's average net assets. This is why the expense ratio matters. The lower the expense ratio, the more of your money stays invested, potentially growing over time. Higher expense ratios can erode returns, especially over the long term. When choosing between different ETFs or mutual funds, comparing expense ratios can help you determine which fund offers better value. JEPI's expense ratio of 0.35 is relatively moderate compared to some other actively managed funds, but compared to passively managed funds, it's a lot higher. JEPI was launched in May of 2020, so its performance history is relatively short compared to other established ETFs. However, since its inception in 2020, it has shown promising results. The income generation from JEPI is a large benefit to the investors in that fund. JEPI's primary goal is to generate income for its investors. It achieves this through dividends and covered calls, as discussed earlier. The dual income strategy has allowed JEPI to provide attractive yields compared to traditional ETFs. Total return: JEPI has delivered competitive total returns, balancing income generation with potential growth from the equity market. And by generating income from premiums, JEPI can offset the downside risk during market downturns. This can lead to better risk-adjusted returns compared to other equity-focused funds. So when the market goes down, JEPI actually outperforms other funds. When the market goes up, it underperforms other funds. So on the downside, you have more protection, and on the upside, you have less protection. This is one of the reasons why it's good for people who are close to retirement. You have more downside protection. On the other end of it, when you're far away from retirement, it can actually be detrimental because on the upside, you don't have as much performance as a regular fund invested in the S&P 500 or any other passively managed funds. JEPI offers a unique blend of income generation and risk management through the strategy of investing in dividend-paying stocks and using its covered call writing. With a modest expense ratio of 0.35, JEPI provides a cost-effective way to achieve regular income and growth potential. Its performance since inception has been promising, delivering competitive total returns and maintaining a high dividend yield. JEPI's reduced volatility and professional management make it an attractive option for income-focused and conservative investors that are close to retirement. As with any investment, it's important to consider your financial goals, risk tolerance, and investment horizon. By understanding the expense ratio and performance of JEPI, you can make an informed decision and determine if it aligns with your investment strategy. Those of you who are closer to retirement might want to consider this fund, as it is a great way to get passive income. But if you're further away from retirement, it's not a good option just because it has lower performance in the long run on the upside. So this has been an overview of the JP Morgan Equity Premium ETF, or JEPI. If you enjoyed today's video, please be sure to hit the like button and subscribe in order to stay up to date with my latest portfolio changes as well as my progress towards paying off my mortgage. If you can, let me know in the comments down below what you're buying. Are you adding JEPI to your portfolio? And I'll see you guys next time.